Good morning. Today we are initiating coverage on Broadcom Inc., ticker symbol AVGO, with an overweight rating. While the market often categorizes Broadcom solely as a semiconductor play, institutional analysis reveals a unique hybrid, a dominant networking silicon provider fused with a high-margin enterprise software aggregator. Our thesis rests on two pillars: the critical role of Broadcom's Ethernet solutions in AI data center buildouts, and the accretive integration of VMware. We project significant operating leverage expansion over the next 12 months as the company executes its proven cost rationalization playbook. To understand Broadcom's valuation, one must understand CEO Hock Tan's strategy. This is not a growth-at-all-costs venture. It is a capital allocation engine. Through the acquisitions of LSI, Brocade, CA Technologies, Symantec, and now VMware, Broadcom acquires franchises with sticky customer bases, divests non-core assets, and optimizes R&D spend. This results in a portfolio with exceptionally high barriers to entry. We are essentially looking at a diversified private equity model operating within a public equity structure, targeting adjusted EBITDA margins north of 60%. Let's pivot to the quantitative driver for the bull case: artificial intelligence. While NVIDIA dominates the GPU market, Broadcom owns the roads those GPUs drive on. Their Tomahawk 5 and Jericho 3 AI switches are industry standards for Ethernet-based AI clusters, challenging InfiniBand. Furthermore, Broadcom's custom ASIC division, building TPUs for Google and chips for Meta, is projected to generate over $10 billion in revenue this fiscal year. This is high-quality, recurring engineering revenue that provides a hedge against cyclical commoditization in standard chips. The VMware acquisition is the largest in tech history, and the synergy estimates are conservative. Broadcom is rapidly transitioning VMware from perpetual licenses to a subscription-based model. We anticipate a reduction in SG&A expenses by nearly $1 billion annually as they streamline sales forces and remove overlapping functions. We model VMware contributing approximately $8.5 billion in pro forma EBITDA within 3 years. This successful integration acts as a stabilizer for cash flows, offsetting semiconductor cyclicality. Turning to the income statement, Broadcom boasts one of the most impressive margin profiles in the S&P 500. Gross margins consistently hover around 69% to 70%, with operating margins pushing 45% plus. This is not accidental. It is a function of their mix shift toward high-margin software. We are forecasting top-line revenue growth of 40%. For the dividend growth investor, Broadcom is a Tier 1 holding. The company generates massive free cash flow, targeting 50% of revenue as FCF. Their policy is to return 50% of the prior year's FCF to shareholders via dividends, with the remainder used for debt paydown, crucial after the VMware leverage, and opportunistic buybacks. We expect rapid deleveraging over the next 24 months, bringing net debt to EBITDA ratios back under 2.5x, which will subsequently reopen the door for future M&A or increased buybacks. Valuation requires context. Broadcom typically trades at a discount to pure-play high-growth semis like NVIDIA or AMD due to its conglomerate discount and lower organic growth rates. Currently trading at approximately 25 to 28 times forward earnings, AVGO offers a growth at a reasonable price, or GARP, proposition. When adjusted for its dividend yield and lower volatility, the risk-adjusted returns are compelling. We view the EV/EBITDA multiple of roughly 18x as attractive, given the software-like recurring revenue stability. A responsible analyst must stress-test the thesis. The bear case for Broadcom centers on 3 risks. First, customer concentration. Apple accounts for roughly 20% of revenue, and any rumors of Apple moving chip design in-house weighs on the multiple. Second, the debt load from the VMware acquisition is substantial in a high-interest rate environment. Third, cyclical weakness in legacy broadband and storage markets could drag down the AI gains. We are monitoring the net debt levels closely. Conversely, the bull case suggests the market is underappreciating the AI infrastructure tailwind. If Broadcom's custom ASIC business grows faster than 20% and VMware achieves 70% EBITDA margins, the stock could re-rate to a 30x multiple. This scenario assumes Broadcom becomes the de facto operating system for the AI data center, controlling both the silicon interconnects and the virtualization layer. In this scenario, we see a path to a $1 trillion market cap within 24 to 36 months. In conclusion, Broadcom represents a core holding for institutional portfolios seeking AI exposure with defensive characteristics. The blend of high-yield capital returns and secular AI growth offers a superior risk-reward ratio compared to pure-play semicons. We are initiating a buy rating with a 12-month price target implying 15% upside from current levels, driven by earnings per share acceleration and successful deleveraging. Monitoring the next earnings call for AI revenue updates is mandatory.